part of the problem in doing what I call seat of the pants analysis and policy implementation, because they don't have a fixed path. I have long been recommending something like a Tailor Rule, so that you have the formula in place and you follow it, and you don't have the jerky moves pivoting from one to the other, which is exactly what you're pointing to. That is the risk. Take a look here in the near term, Tom. December 13th, there is Jerome Powell sending the market upwards like a rocket ship. Yesterday, he pulls it back. What happened between December 13th and yesterday to cause a big change to hawkishness? Nothing. If anything, inflation numbers came out more benign than expected. So this is what is the problem with not having a long-term view on the part of the Fed.
The problem I got a Tailor Rule, and it's beautifully done out in the Bloomberg terminal. I got the neutral real rate, guess that. CPI, I guess I can grab that. I got a Greek letter named alpha. We almost named vet bill alpha. Then I got a beta. I got an Okun factor.
Oh boy.
And I got a Nehru suit I've got to wear when I look at the Tailor Rule. Come on, Sri, this is mathematical mumbo jumbo. How do you use an algebraic Sri-Kumar rule when I got a pandemic and a triple stimulus? It doesn't compute.
You do it in two ways. One is the Tailor Rule is sufficiently flexible, meaning that it is not a fixed formula, and it basically says that when inflation is above target or below target, what you should be doing. When GDP growth is above or below what you want it to be, what you should be doing. And it allows you some amount of flexibility between those terms. You don't have to go to the Okun rule. You do not have to go to the others. If you follow any particular rule diligently, you would be a lot better off than what we are doing now, where we don't have any fixed principles. That's where I come out at. It doesn't matter what principle you use something as a rule rather than just decide that morning what you're going to do with interest rates and quantitative tightening.
Sri, we've had a number of guests on over the last several weeks, both academics and market practitioners, who say the Fed should be cutting rates now. Inflation is already whipped. How do you view that kind of call?
That is the call that we had in the 1970s, and we know how it turned out to be.
Not so well.
Because when you cut interest rates significantly, and if you did that today, the markets would rally. Consumer spending would increase. The economy would then temporarily go on a much faster growth setting. Inflation will pick up, and then it will make it much more difficult for you to bring the inflation rate down. That is the risk of cutting down interest rates sharply today.
Sri, are you surprised about how resilient the consumer is? I mean, we just had Royal Caribbean Cruise Lines take their guidance up. People are spending. They're going on cruises. They're going on trips. They're buying stuff. I'm actually kind of surprised how resilient the consumer is.
There are two reasons for that, Paul. You raise a good point. First of all, I think there was an immense amount of fiscal stimulus that was provided to the economy. At the end of 2022, the estimate was for $1.5 trillion worth of excess savings were in the hands of the consumers. So it is being spent. The last months of the Trump administration, the initial months of the Biden administration, the stimulus that came forth is still being spent. That's one reason. Second, look at what has happened with the recent numbers on consumer disposable income and savings. Savings are rising much slower than consumer disposable income. Sorry, I should say the other way. Consumer savings are not rising. Consumers are essentially dipping into their savings in order to finance their spending, and that is going to cause it. Credit card loan defaults are increasing in the case of banks, and that is another way in which the consumer spending is being done. You saw what happened with the banking problems in the last couple of days. I've been writing, Paul, that especially with the consumers, that you're only seeing the tip of the iceberg. You're going to see a lot more in the next 6 to 9 months.
So, given that backdrop here, do you think the Fed that message yesterday was pretty clear? We're don't bank on us cutting rates in March. Do you think that's the right message? And do you think that message is subject to, if the data changes, maybe they'll change?
I would say that if they stick to March and if they wait for inflation to significantly come down before they cut rates, that is the correct policy. But if what Jerome Powell does is to switch messages from meeting to meeting, from December to this meeting, with no change significantly happening in the economy, that is going to be a problem. It's going to cause volatility. It's going to cause uncertainty in markets. But unfortunately, that's the way the Fed operates.